Hi, this is Keith Schneider, CEO of MarketGage.com, and this is May 3rd, 2020 edition of Market Outlook. Again, until this craziness sort of settles down, I'm going to continue doing a combined video. And so let's get into the details. So first of all, we had what was looking like a pretty strong week, and the last couple of days really gave back pretty much everything, with the exception of some of the outperformance in the IWM. So let's take a look at the details and see what some of the key points are setting up for next week. So as you can see, the S&P backed off from what was looking like a pretty strong week, and it actually ended up closing marginally down. So the 50-day moving average coming in around 275. And one of the things to note is that probably the key day here to watch is the day that the S&P traded 100% under the 50-day moving average, and that was somewhere around that 270 level. And so you definitely want to watch that. So this key price point here is important because that would mean both the failure of the 50-day moving average and the first or the most recent day that are clearly traded under the 50-day moving average that is under the 50-day moving average. So with that, one thing you can certainly see, let's just go back, is that you've got some interesting trend lines that you can draw in off the lows. So, right, one thing you can see, right, we're basically violating the trend line already, but you really wanted to take out this swing low in here. Now, the other thing to note is we got a cross of the 50-day under the 200 in the Qs, and we also closed under the 10-day moving average, which we've done across all of the indices. The other thing to note is if we take a look at our real motion gauges, even though we've been trading well above the 200-day moving average, our real motion indicator here is running opposite to that. We're trading under the 200-day of real motion. And not only that, we're already pretty much have been crossed under in terms of the real motion phase back in late March. Now, the one thing that seems to be holding up and doing a bit better was IWM. So one thing to note is you can see our real motion indicator here running a bit stronger. It broke out earlier, right, than IWM through the 50-day and is holding here. But again, what you really want to watch is a breakdown of this trend line and important support just underneath here. So these are really good plays to watch. The other thing to note, which is I think out of all of the different indices, actually one of the clearer ones, because the most important support level just before we took out the 50 is under the 50-day moving average in the Dow. So this probably the Dow is one of the clearest reads because if we break down beneath this little support here just before it broke out, that coincides just under the 50-day moving average. So watch the Dow here for an important breakdown. On the other hand, if we hold around these 50-day moving averages, you could get a bounce. So again, this is a very fluid environment. We're going to be totally flexible. We know the point to abandon our overall short-term positive read on pure price action, although it definitely did deteriorate with closing under the 10-day moving average across all the indices. Okay, so further muddying the waters and creating what I would call a very mixed picture in terms of risk on and risk off is the fact that utilities, despite that the market basically ended up slightly down across most of the 3 out of the 4 indices, was the worst performer for the week. And the stuff that really got hit the hardest was actually one of the better performers, right? You can see down here a lot of stuff that was really beaten up, energy and home builders, right? All the worst performers year to date caught a bit of a bid. So very, very mixed picture. Technology doing fairly decent, not great, but you compare that to pure semiconductors, right, which is certainly a spec sector and one of the big growth sectors that got hit. So, both risk off and risk on leaders have been underperforming for the week. And the other thing to note is retail up 3.2%. So big outperformer, and still year to date a big underperformer, and that has been lagging for quite some time. So mixed picture here, can't really take a read other than thinking that market action will stay sort of choppy and volatile. Okay, now moving on to market hotspots, where we're looking at really the global picture of different asset classes. One thing that's clear is the stuff that's sort of been beat up the most, like Brazil, actually caught a bid, and over the last week did very, very well. But still, it's you're in a situation where things are not looking good overall. It was more of a technical bounce. So, even oil and gas exploration down 40% over the last 6 months did pretty well. One of the leading areas or asset classes in the last week. The other thing to note is what was leading, Biotech, even though it's sort of front and center in terms of the industry groups leading the charge against the virus, it took a breather this week, down 4%. So, getting a clear read, again, confirmed globally, mixed picture. Stuff that got beat up, bounced. Some stuff that did well, paused. And that included gold miners, and even long volatility, which gained really nicely on Friday with the sell-off, but still for the week was basically flat to down a little bit. But when you take a look at it, right, a lot of the leading asset classes over the last 6 months, right, all were down, and a lot more than the underlying market. So again, more of a mixed picture. Okay, now taking a look at our risk gauge, one thing that's interesting is it actually improved a little bit by the weekend, but looking underneath the hood, you can see last week we were at 60% read, positive, slightly positive, but more in the neutral territory. And we actually picked up one more positive gauge. But if you take a look at the underlying picture and just seeing how far those key ratios are above critical points, you can see we're on the cusp of possibly switching. So a sell-off, right, as you can see here, S&P versus the long bond, basically holding on to its positive relative movement here. High yield debt also on the cusp of a possible change. The S&P versus gold also, as you can see, S&P losing some ground, certainly by the end of the week. as gold was up on Friday and S&P was down sharply. And the same thing in terms of inflationary pressure versus gold, which is more, it has inflationary sensitivity built in, but on a relative basis versus lumber, still lumber underperforming. So as you can see, any further weakness here, we could end up flipping into a sell signal in our risk gauges. Not there yet. We need it, but we need to be vigilant and keep an eye out on how this plays out during the week. Okay, the other thing that's important to note, and I've sort of been really thinking about this, is that small caps that had been really pummeled and underperforming for quite some time. In fact, for the last 15 years. And again, growth, high momentum stocks, that's been the place to be. Look what's happening here. You can see versus the S&P small caps, although it gave up some gains over the last 2 days, overall, we're starting to show a little bit of strength. What I really want to see is it taking out this 0.448 level, looking at this relative to the S&P, and that would show really good relative strength in small caps. And that could tell you that we're in a different phase here and starting to rebalance, which happens as the bear market sort of plays out and things transition. So could we get another test? Yes. And it wouldn't be surprising to see, as we're getting a test as part of the bottoming process, that IWM continues strength. And if we look at that across the board, we can see mid caps versus small caps actually acting very similar to IWM, and the mega caps, the Dow stocks, still lagging the S&P. So this theme is happening across the board, and it's telling you that there potentially, if this holds up, an important shift occurring that tells you a lot about the economic cycle that we're in. Okay, now moving on to sectors and the modern family. One thing that's clear is that XRT retail, right, you would think would have been really pummeled with the earnings report. Actually, if you compare it to the underlying indices, it's actually doing better. And of course, we're trading above that 50-day moving average. Although we backed off, we started running pretty rich here in terms of price movement, hit the upper end of the Bollinger Band. We did close under the 10-day moving average. So net decent volume, better performance in retail. I take that as a positive sign because retail really needs to catch a bid to tell us that the virus induced sell-off is abating or possibly over. So there's that. Now, again, just looking at IWM as part of the modern family, you can see it's still holding up on a shorter term basis. Its volume is decent. So we really need to hold here. And I pointed out, right, we really don't want it to trade under that 120 or 122 level in IWM. Okay. Now, the other thing to note is two of the leading sectors got hit a little bit this week, which is interesting because it really was mostly a decent week. But take a look, SMH, Semiconductors, broke down under not only the 10-day moving average, under the 50. And momentum, right, sort of very similar picture to what the Qs are, starting to deteriorate, right? Not keeping up with the overall price action. And as you can see, we're really in the process of breaking down. That is not a great sign. We want our leading sectors, and certainly the more speculative sectors, to continue to lead. The other thing is biotech, which of course is getting attention. We need cures, we need vaccinations, we need remedies for the virus. Had a really pretty good run. It sort of outperformed all the other industry groups and sectors. And right now, it's still outperforming, but paused on the week. So that is certainly important to take notice. I really would like to see this stuff regain its 10-day moving averages, and that would tell me that the a potential rally is back on course. Okay, taking a look at country ETFs. This is an interesting way to get a global market perspective. One thing that's clear is that the country that had the best response to the pandemic, Taiwan, has been performing the best. So if you take a look over the last 3 months, right, it's still down almost 7%, and about the same over the last 6 months. So if you compare that to virtually everything else, you can see China coming in second, right? It definitely got its response down, even though a lot of people say they haven't been straightforward in telling the world just how bad things are. At least internally, they seem to have it under control. But no question, Taiwan, as you can see, the best performer on both the 3 and 6 month basis. So the relationship between the response to the virus has a direct impact on the direct impact on the financials and obviously the stock market. Hence, some of the worst response, for instance, Brazil down 48% across the board. Now, we did get a bounce this week, but still, overall, this is horrible performance. And as you can see, really across the board, Taiwan doing well. And if you take a look at the S&P here as our core benchmark, it's sort of in middling in terms of performance. It's down almost 14% over the last 3 months. So not the worst, not the best when you certainly compare it to Taiwan. So the other thing to note is over the last 6 months, Switzerland is doing well. Not because so much of its response to the virus, but more about its overall economy and how it's more pegged to gold. So as you can see, over the last 6 months, it's actually the best performing country fund out there. So 2 interesting themes: how a country is responding, and also its overall financial system and how it's pegged to some hard assets, or not pegged, but at least associated. So Switzerland is more closely, has a larger gold reserves than most other countries, and more related to gold than the amount of central banks and holdings for other countries. Okay, now the next thing I want to highlight is something which sort of makes sense, which is hoarding and potential inflationary pressures, which is DBA. So DBA is the ETF for soft commodities. It's a blend of all softs. And in essence here, this is the weekly chart, right? This is a long-term channel going back years. You can see we hit the bottom of the channel, But one thing that's interesting, as we were actually trying to make new lows here at the bottom end of that channel, our momentum index bottomed out and we bounced. Now, that doesn't mean we're out of the woods yet. One of the things I'd be definitely looking for is if we can get above that 10-week, not 10-day, 10-week moving average, which is just above 1410, let's say, with a little bit of slippage, that could mean that we actually did bottom here. We put in some work, probably a month or two of downward, eking out new lows, but not really having much more downward momentum. So this is something to keep an eye on as well. Now, the last thing I want to cover is taking a look at gold and oil. So right here, in terms of gold and oil, we had mentioned, I think last week, that the momentum had sort of paused, right? We sort of eked out like a new high here, but weren't really able to get much more momentum to the upside. So we're really watching this as sort of almost like 3 weeks of compression. We don't want to take out this swing low, and if we can certainly break out above the recent highs, you've got now enough compression where I wouldn't be surprised to see this ultimately test the all-time highs in this contract. And we're, again, on the verge of possibly breaking out on a relative strength basis versus the S&P. In terms of oil, it looks like not much new is happening. We're in a situation where downward pressure is there. I don't see any real divergence in momentum, and certainly it's underperforming virtually everything in the world. So there you have it in terms of the overall markets today. As you can see, mixed bag in a lot of things, confusing message. So that means again, I always defer to these type of environments in great risk control and managing trades. So bigger picture, obviously the market is looking a bit dicey, but the bigger picture overall is still what I would call negative, and we're certainly vulnerable. But with that being said, we could be set up after this week's sell-off if we can get above those 10-day moving averages on the key indices for another test of, let's say, the overhead, which is sitting at around the 200-day moving averages on the key indices. And I guess one final thing is, considering the amount of money that's being pumped in, one of the things, or probably one of the only things that really makes sense, is that longer term gold and commodities and inflation is going to hit. I don't see the Fed backing off on accommodating and keeping the helicopter money flowing. So with that, I see constant upward pressure for hoarding of hard assets, especially gold and even gold mining stocks. All right, hope this helps. See you next week, and bye for now.